There is a question keeping economists, mortgage holders, and everyday Australians up at night. Is Australia heading for a recession? Honestly, when you look at the data, the answer isn't as simple as you'd hope. The gap between what the headlines say and what is actually happening in the economy is bigger than most people realize. Let's start with the good news. Australia's GDP grew at 2.6% annually in the December quarter of 2025. That was the fastest growth we had seen in almost 3 years. On the surface, that looks like a healthy economy. But here's the catch. GDP is a backward-looking number. It tells you where the economy was, not where it's going. That distinction matters right now more than it has in years, because when you look at what has happened since that GDP number was printed, the picture changes fast. Consumer confidence just crashed. The Westpac Melbourne Institute Consumer Sentiment Index dropped 12.5% in April to 80.1, the lowest reading since the pandemic. The ANZ Roy Morgan Consumer Confidence Survey hit a record low in late March, lower than anything recorded since the survey began in 1973. Think about that for a second. Australians haven't felt this pessimistic about money in over 50 years. And it's not just feelings, it's behavior. Household spending fell 0.5% in December and has barely recovered since. People are pulling back. They're not buying clothes, they're cutting back on eating out. Furniture retailers like Nick Scali and Harvey Norman have seen their share prices drop 20 to 25% in just 2 months. Buy now, pay later platforms are reporting surging usage on essentials like utilities, insurance, and healthcare. Financial counselors say mortgages are now the #1 issue people call the National Debt Helpline about. That pullback in spending is exactly what economists watch when they're looking for early signs of a recession. Three big forces are hitting the Australian economy at the same time, and that's what makes this moment so dangerous. The first force is interest rates. The Reserve Bank has hiked rates twice already in 2026, pushing the cash rate to 4.1%, and the pressure isn't letting up. Markets are pricing in a 62% chance of another hike on the May 5th meeting. Most major banks, including ANZ, Commonwealth Bank, and NAB, are forecasting that increase. Every single rate rise means higher mortgage repayments, tighter household budgets, and less money flowing through the economy. The second force is the energy shock. The war in Iran sent oil prices surging from late February, and Australia imports around 80% of its fuel. While a ceasefire was recently agreed upon and extended, don't let that fool you into thinking the crisis is over. The Strait of Hormuz is still effectively closed. The U.S. has imposed a naval blockade on Iran, and ships are still being disrupted. Crude oil has come down from around $110 to roughly $95 a barrel, but that's still well above where it was before the war. Energy Minister Chris Bowen says Australia now has 46 days' worth of petrol supply, which is better than when the war started, but the government is still scrambling to secure emergency diesel shipments. Unleaded prices have come off their peaks in some cities, but diesel has nearly tripled since the start of the year. This flows into everything from the price of groceries to the cost of construction materials. Westpac economists estimated the fuel shock could add over 1% to headline inflation for March alone. Research has shown that a $1 increase in petrol prices has the same impact on a household as losing roughly $3,475 in monthly income. The third force is collapsing confidence. Business confidence, as measured by NAB, fell 29 points in March. When business owners lose confidence at that speed, they stop hiring, delay investments, and freeze. The damage is already showing up in business failure numbers. 2025 produced record insolvencies across Australia, and 2026 is on track to match or beat it. Construction alone saw over 3,500 firms collapse last year, the worst on record for that sector. Hospitality insolvencies surged 57% in the 12 months to March 2025. Here is where it gets really uncomfortable. Unemployment has already started creeping up. The official rate hit 4.3% in both February and March. While still low historically, the direction matters. It's moving the wrong way. The NAB Business Survey's measure of capacity utilization is sitting at levels more consistent with unemployment above 5%, meaning businesses are already operating as if the economy is weaker than the headline employment numbers suggest. On top of that, real wages have started going backwards again. Inflation has now outpaced wage growth for the first time in 2 years, which means the average worker's purchasing power is shrinking. So, are we in a recession? Technically, no. A recession requires 2 consecutive quarters of negative GDP growth, and we haven't recorded that yet. However, there is a number that gets overlooked in the mainstream conversation: GDP per capita. The total economy might still be growing, but when you divide that growth by our rising population, the picture looks very different. Australians have been living through what some call a per capita recession for a while now. The economy grows on paper, but the average person's slice of the pie keeps shrinking. Your cost of living goes up, your real income doesn't keep pace, and you feel poorer even though the official statistics say the economy is fine. The RBA is stuck in an incredibly difficult position. Inflation is still running at 3.7%, well above their 2 to 3% target. They want to keep hiking to crush inflation, but every hike they make pushes the economy closer to contraction. The deputy governor actually used the word nightmare recently, calling this a classic stagflationary shock, where inflation goes up and economic activity goes down at the same time. What does this actually mean for you? It means now is the time to get serious about your financial position. If you have debt, especially variable rate debt, stress test your budget against another 2 rate rises. If you can't handle repayments at 4.6%, you need a plan right now. If you have savings, this is the time to build your buffer. Cash reserves become your lifeline if the economy does tip into recession and job losses increase. If you're investing, understand that volatility is not the same as loss. Markets are going to be choppy, and the ASX has already pulled back from its highs, but corrections are often where long-term wealth is built if you have the cash flow to stay in the game. Australia might avoid a technical recession. The most likely outcome right now is a period of very weak growth rather than a full contraction, but the margin for error has gotten razor thin. One more shock, such as the situation in the Strait of Hormuz worsening or a sharper drop in consumer spending, and we could tip over. The data isn't telling you to panic, but it is telling you to pay attention. The smartest thing you can do right now is make sure your financials are ready for whatever comes next.